Good morning, everyone, and welcome to Intelbras' fourth quarter 2025 earnings conference call. My name is Bruno Teixeira. I'm the head of investor relations at the company, and it's a pleasure to be here with you today. Joining me is Mr. Enrique Fernandez, our CEO, for our earnings call. Please note that this conference call is being recorded and will be made available to the company's on the company's investors relations website, where the presentation is already available for download, and the replay of the webcast will also be available after the call. And as usual, for the Q&A session, we recommend that you use the Q&A icon to send your questions. That is at the bottom of the screen. And please write your name, your company, and the language you'd like to ask your question in. And we will answer these questions in the order they have been sent to us. When your name is called out, please turn on your microphone when the pop-up allows you to. The information contained in this presentation and any statements made during this conference call regarding Intelbras' business outlook and projections and operational and financial targets are based on the management's beliefs and assumptions and on information currently available to the company. Forward-looking statements do not guarantee performance. They involve risks, uncertainties, and assumptions as they refer to future events and therefore depend on circumstances that may or may not occur. Investors should understand the general economic conditions, market conditions, and other operational factors may affect Intelbras' future performance and may cause actual results to differ materially from those expressed in such forward-looking statements. And with that, let's begin the presentation. You can already see our slides. Let's start off with our highlights from the fourth quarter. We have a 9.3% decrease in revenue. It's 1.067 billion Brazilian reals. And there is an increase quarter on quarter. It's what we normally expect for the quarter. There is an improvement on EBITDA. There's a minor dip year on year, but there's a substantial increase quarter on quarter. As for net income, we see a substantial increase year on year. We are almost at 138 million, with an 8.2% increase year on year, and with a minor decrease quarter on quarter. This is basically the impact from the deferred income tax that brought the lower results in the third quarter in comparison to the third. If we look at the results at the bottom line before taxes, then we have a 33% increase year on year, and the decrease quarter on quarter, that is almost 7%, would actually be a 5% increase. So what has impacted the results here was the deferred income tax that went into the fourth quarter. And I think it's important to mention that in the course of the year, as usual, our income tax is very close to zero in 2025 as well. And an important indicator that we have been monitoring is ROIC, and we can see that in the quarter-on-quarter comparison, there has been an improvement and a 3 percentage points decrease year on year. But it has been climbing in the past 3 Qs. As for the margins, we see that a gross margin is quite stable in comparison to the third Q. The EBITDA margin has increased both year on year and quarter on quarter, and the net margin has a minor decrease here in the quarter on quarter comparison, but there is an increase year on year. Now, when we look at the net revenue, I like to linger on this chart a bit longer. We have historical data here, but I will be focusing on the period going from 2021 to 2025. And let's understand how revenue is structured. And let's focus really on these four last years. And we see that revenue hasn't really been going up in these past 4 years. But when we focus on this period from 21 to 25, in 21, half of the company's operations were in security, and the other half was basically ICT and energy. Energy with the expectation of accelerated growth. And we did see an increase in revenue there in 2022, mainly driven by solar power. And then there is a change here into 2023 because of the regulatory changes. And at this point, we understood solar power a bit better, and we started prioritizing an increase in efficiency and profitability more than an increase in our market share. We weathered the challenges of 2023, and in 2024, we saw substantial solar uh, revenue with off-grid powers and power plants. But we removed that from our plan in 2025. So we see this difference here because of solar energy. And part of the increase we see in 2024 comes due to the GPON portfolio. We signed a deal with a good partner at the end of 2023, and that has also contributed to the company's revenue in 2024. And in 2025, we talked a lot about the risks and the possibilities in the GPON business. And in the second half of the year in 2025, we brought the revenue to healthier levels, lower levels, but we've discussed this at length. And now I have 60% security. These 2 years have a more similar revenue structure that we understand is actually suitable for us to start growing structurally in a more robust fashion. Now, when we look at the EBITDA chart, and we normally look at this one as well in our earnings presentations, let's look at the two past years and look at the four halves of these years. We have the comparison here year on year, and that shows a substantial impact. But the first quarter, 2024, shows our EBITDA margin higher than our historical levels. It was close to 15 or 14.7. And then we got closer to 13, close to historical levels. The first half of 2025 had an impact because of the system migrations and the works we did in the first quarter, and we saw an EBITDA margin lower than what we normally see, about 11%. And now in the second half 2025, we are climbing back up. So we had three halves going down, and now we're reaching an inflection point, going back to the company's expectation levels. So this is a clear sign that the decisions made in the past halves and in the course of 2025 are bearing results. And now let's look at the fourth quarter specifically. EBITDA is 165 million in the fourth quarter 2024 and 162 million in the fourth quarter 2025. That was impacted by the drop in revenue. And even though the margin is lower, you lose a little bit in the gross profit. And we have, of course, expenses controls. We always try and find more efficiencies. And we have a result with lower revenue with a 13.9% margin. It's a very interesting margin. So the path ahead is very clear and we can see it. When we look at the consolidated gross profit, it's also impacted by lower revenues, but we see a slightly higher level than what we were used to seeing. And we'll, of course, continue to work to deliver these results. And we know that this is a macroeconomic scenario with high interest rates, and there is an impact on PVA. We talked about this in the previous quarters, and this is a chart that I show you again, just to show that we're on the same level of PVA impacts on our gross margin. The inventory is going to be financed again, and it will become costs, and we'll see the cost PVA contributing to a lower operating margin. As for the three segments, our three business units, we see that security accounts for 62% of the revenue of the fourth quarter and 61% of the revenue of the year. There is a 5% increase year on year. We see that the market activity is impacted by the macroeconomic scenario. The average ticket has been a bit lower in the market. That has an impact on the turnover and the sell-in into our channels. And the competitive scenario is also the same. It hasn't changed. And we see the gross margin is changing as per our expectations with the effects that we see with changes in mix, cost, and flow. Now, as for ICT, it accounted for 22% of our revenue, both in Q4 and in 2025 as a whole. The revenue decrease has to do with the GPON segment. We see that the numbers are in line with seasonality and with what we had planned. We see that security for enterprise networks is going up in SMEs. We have a substantial market share there. And the gross margin is fluctuating within the normal range. And energy, last but not least, energy, it accounted for about 17% of our revenue. There is a substantial difference here year on year. We talked about this last year. We're not going to be focusing on major projects, and we're going to be focusing on roof generators, focusing on profitability. These two decisions caused this impact on revenue. And roof generators had a slightly lower sales level in the second half of the year, but we have an interesting revenue mix, and we see that the quarter, the quarterly increase is mainly driven by the UPS and power supply product lines. The energy mix is healthier, it's more robust, and this is very interesting when we think about the long-term strategy. The solar power scenario is very similar to what we had seen in 2025. And for us to really face this context more efficiently, on the 30th of December, in the shareholders meeting, we decided to incorporate Renault Vigi. We integrated Renault Vigi, aiming at strengthening our operational structure for the solar business unit. From a cash generation perspective, well, we are a company that generated a lot of cash in 2025, very robust cash generation in the fourth quarter. And the free cash flow is 16.232. It's quite robust. We paid 300 million in dividends in December. We brought it forward. So the financing fund, or rather flow, was impacted by this decision. And we closed the year with 1 billion in cash and a very robust financial structure to start 2026 very robustly. From a CapEx performance perspective, we had 100 million in CapEx. That's half of what we had last year. And the CapEx levels are quite different to what we had been seeing in the years where we're investing and expanding. From 2021 to 2024, we had a very strong expansion cycle. And then in 2025, we had less need of expansion, and that's what we expect for 2026 as well. So CapEx should be similar to what we had in 2025 and now in 2026. And before I give Enrique the floor, let's talk about the perspectives for 2026. 2026 will be a year that will reflect the strategic decisions made in 2025, and this could impact revenue growth, but it will also improve our profitability and our ROIC. We'll see this happening in 2026. And this improvement in operations, which is very present in the, or is going to be very present in the communication channel. So the customer journey, the customer will have what they need delivered with, or rather as smoothly as possible. In gated communities and SMEs, we really want to deliver this value. This is what we have been devising, and this is what we're going to be executing in 2026. And our business generates cash. It's quite healthy. And in 2026, we expect the working capital to also perform or improve. So we expect to continue to make our financial structure more robust. And this is how we start the year of 2026. And I'll stop sharing my screen and I give the floor to Enrique. Good morning, everyone. Thank you very much for joining us in our earnings presentation. I'll structure today's discussion into three parts. First, I'll expand on Bruno's remarks regarding the fourth quarter. Second, I'll walk you through the key dynamics across our business units. And third, I'll close with a summary of the year and outline our priorities for 2026. This quarter reinforces the decisions we made throughout 2025. And the quality of our results is going up. So even in a more selective demand environment and with intentional adjustments in specific portfolio lines, the quarter-on-quarter improvement in EBITDA margins shows that operational discipline and execution are gaining traction. Throughout 2025, we've made progress in standardization, management routines, and operational simplification, mainly with SAP as an enabler to reduce complexity and increase efficiency. And all of this with a very clear objective, namely improving customer experience and strengthening the health of our operations. Some of these gains are already visible, and others will be visible as the execution matures. In cash and working capital, we see we've performed consistently. We realigned inventories, and as planned, we resumed purchases in the second half, and that is in line with our new strategies. The company had 1.5 times EBITDA and distributed 300 million reals in dividends in December. But our cash position continued to be robust, allowing to navigate cycles and invest selectively and capture opportunities when they arise. We're a company with a strong growth mindset and a long-term ambition. Over the last 12 months, the pre-tax ROIC was at 15.1. Bruno mentioned that. And it's showing quarter-on-quarter improvement. ROIC has been a reference for our decisions business by business. Now, when we look at the business units where the decisions are clearer, if we look at security, we see that we continue to become more relevant and deliver positive performance. We want to work closely with the channels, and we continue to read the market very carefully. And we have been maintaining our market share. We have not lost market share in 2025. Now, in 2026, the market should continue to be competitive. We want to be more efficient. We want to have more focus in our execution. There's a lot that we have to do when it comes to solutions, more integrated products. We want to have a more integrated type of sales where we have cross-selling between different business units, and we can really boost the company's results as a whole. But still talking about security, the gross margin fluctuated, but within the expected ranges due to mixed pricing and the cost dynamics. So we'll continue to have specific actions taken in specific contexts and always looking at the cost reduction possibility. That's always a focus. How can we have the best product, but how can we have that in a more economical way, reducing costs in a more productive fashion as well? And there is a cross-cutting point here, which is the memories. The market may have a question about this. There's a global movement that impacts the price and availability of memories, and we have been quite active in looking at possibilities to deal with that. In the short term, everything is well managed. And now, when we look at ICT, we had some important adjustments there, especially in GPON. We're striving for more balance when it comes to profitability, ROIC, and revenue. We want to have a good relationship with suppliers, but in a healthy manner. So we can have a different revenue base with more profitability, with better returns. And this is the economic beacon guiding us. As for our partnership with Fiber Home, 2025 was a strong year. Bruno talked about it. And 2025 was a year to adjust expectations and strategies. Now, the format for 2026 is already designed, and the next quarters will give us more evidence to guide future decisions. Now, when we look at fiber optics and cables, we're talking about fiber itself. In Brazil, the market is really heated because of the Tubarão plant, and it's operating as expected. And when we talk about new avenues in ICT, the competition with with the competition is so strong. We're working with SMEs and we're working with major projects that are going to be important growth avenues for the company. And as for energy, the quarter shows the strategic repositioning that we had in the quarter. There's no magic trick there. We directed our efforts for profitability and return and not to grow market share in solar energy. So in 2025, there was an impact on revenue because there was no major project. And in the fourth quarter, especially, we had less sales in roof generators. And I think it's important to stress a point here. We did not discontinue solar market. It's big, it's important, and well, it's important for our main market activities in an integrated fashion. And so in energy, we had an improvement in margins and also growth quarter on quarter. So we see that the mix is healthier. This is very positive. And in 2026, we continue to have our solar profitability strategy with discipline to grow in the other lines of the segment as well. So we expect stability in solar volume and a structure that will deliver results without the need to depend on revenue. And we continue to see improvements in UPSs and vehicle chargers, and we're very attentive watching the macroeconomic scenario. So we're getting to the end of 2025. And we can see these gains being generated. So in 2026, the adjustments will probably finish being made. And in the second half of the year, we should see more gains in efficiency with the simplification, this capital discipline that we've been talking about for so long, that should be more visible in operations. And also ROIC, which was a point that we recurrently talked about last year. Working capital continues to improve and will continue to improve. And inventory efficiency also helps sustain the free cash generation. And you can be sure that all of this that is being done has a very clear objective, which is to resume growth, especially in businesses where we have a competitive edge, generating more value in the long run for the shareholders and for our customers. Thank you very much. Bruno and I are available for your questions now. We'll take your questions now. Thank you, Enrique. We have Victoria, an analyst from JP Morgan. Victoria, please. Thank you for taking my question. I've got two questions. The first one has to do with security. What is your perspective for growth in this business in 2025, considering the more challenging macroeconomic scenario and the competitive scenario? And do you see any specific go-to-market segment being impacted by the macro scenario as well? My second question has to do with anti-dumping. Can you give us a bit more color about that? How much may still carry over into the first quarter? And can you talk a little bit more about the segment? Do we expect any offenders for this measure, or should there be any review of the portfolio? Thank you, Victoria. Thank you for being here with us. Security grew 5%, and it will continue to grow. especially in integrated projects software. We didn't lose market share. We maintained our market share, and we believe that security will continue to have a strong demand. And as the economy improves, that demand should also improve. So we expect to see growth in 2025. As for anti-dumping and fiber optics, it happened in Brazil, so that means that imported products um, had over 100% uh, taxation. So that boosted the Brazilian manufacturing. The anti-dumping really improved the Brazilian industry. So the end product for the uh, customer mainly had an increase in price, but it's still much better than the imported product. So this is boosting sales in Brazilian companies as Intelbras is being boosted in the fiber optics cable sales. As for new offenders that could impact our portfolio, well, the major actions that we needed to take have been taken. They were taken in 2025, so there's no major impact that we expect. If I may just complement your answer, Victoria may have thought there would be challenges in um, revenue, but the anti-dumping measure actually helps the national industry. Anti-dumping was validated at the end of December. So for this 2025 results, you can't see any impact there, but we'll probably see the impact in 2026 with the whole industry with anti-dumping applying to any imported cable. Thank you very much for taking my question. Thank you, Victoria. Silvio Safra from Safra, you may ask your question. Silvio, can you hear us? Can you hear me now? Can you give us some more color about the competitive environment in security? The price reductions, were they responses to the competition, or it was a proactive action you took to increase market share? And the CapEx levels in 2025, they're expected to be the new normal, say, for the company. Well, there are cycles in CapEx. From 2021 to 24, we had an expansion cycle. And at this point, we don't need to expand. So we're capturing the synergies and the efficiencies we had in these investments. So in 25 and 26, we have the expectation of lower CapEx levels. I won't say that 100 million is going to be what we'll have, but it could be a ballpark reference. This is what we see when it comes to opportunities in 2026. And it's important to say this on an earnings call. We see that Manaus is a region that is um, protected by the tax reform. And we've been trying to find more opportunities in Manaus. And if we see these opportunities, be it in land lot, be it in a plant that may be inactive, then we should act. So this would lead to different levels in CapEx in 2026, but it wouldn't be any major investment. But if this opportunity arises, we will act and we will have this um, this information shared with the market. So around 100 million, this could be a reference. And with the cycle, we should expect something similar in 2026, what we had in 2025. And in 2027, we'll see how new demands arise and how revenue behaves. As for security and price reduction, I believe you may be looking at results, but you can't forget that we have product mixes. Sometimes there is an impact on one product more than another percent, like from a percentage standpoint. In 2025, we didn't really have any major changes in the pricing tables, uh, nothing that changed the structures. What we have is maybe to have a spot change made to a specific item, to a specific product, or in a specific region. Then you may have an action to increase or maintain our market share. So there's no structural change. Every improvement we see in cost or in operating efficiency is normally passed on. And of course, we need to look at the whole picture, what makes sense, what doesn't, but we will pass it on to customers to have Intelbras more and more present in our customers' home, but also more affordable, making technology more accessible, allowing more and more people to have access to it. But again, no structural change. Thank you very much. Gustavo from UBS. Thank you for taking my question, everyone. Good morning. And the message from the management, you talked about growth that is slightly higher than inflation, and there's a plan to increase um, revenue above inflation. Do you expect that to take place in 2026 or in future years? And you talk about assumptions that are conservative in the market. What are these assumptions? What are you thinking about? Inflation, interest rates? Thank you. 2026 is a year that will bear the results of the decisions taken in 2025. I won't give you exact figures, of course, but the inflation as a target is a challenge. That when we look at the revenue, in the revenue composition, as I mentioned in the, in the presentation, we want the revenue to be more robust, and we want to have a foundation to have the real growth in the 5-year plan. So the real growth is expected to take place in this 5-year plan. When you talk about the assumptions in a company as large as Intelbras with so many working fronts, we need to have a bit more clarity on their breakdown. This is really based on a business unit reference. We need to look at the market where we operate. We need to look at our market share. We need to look at the competition. So the assumptions vary substantially. But in this analysis, one thing that we take very seriously is controlling expenses. We first deliver and then invest more where we need. Of course, not in businesses where we have uh, market expansion and more innovation where we need to gain more market share. But just naming different examples of markets just for you to understand our rationale. When you look at electronic security, for example, analog cameras, well, that's an important business. And the market is being addressed by a different technology type, AP technology. So then that market goes down. There's one technology that is replacing that one. The same applies to Wi-Fi replacing IP. So we have a more conservative assumption for analog and a more aggressive assumption for IP and Wi-Fi, for example. These are future trends, and we need to continue to work to improve and expand on this. So again, the assumptions will vary very much from one um, business segment to another. And on the Investors Day, we shared with you what the assumptions are that we are basing ourselves off of. So you can find all of this information there, Gustavo. Thank you, everyone. Just to try and see if I understood the first question. The the medium term growth message. In the past, you spoke about 9% growth above inflation. Of course, the recent quarters have posed challenges for this real growth. This growth above inflation, it should take place in the coming 5 years. Is that right? Just to try and understand where we should be, and so we can gauge our expectations. We are already on levels of different companies in the recent past, and 9 would be very ambitious. I don't think it's very wise to set a target for real growth above inflation, but um, well, the objective is to continue to grow, to generate more revenue and create more value. Okay, thank you very much, Enrique. Maria Clara from BBA. Morning. Morning, Bruno. Thank you for taking my two questions. They have to do with the final remarks in the release. You should deliver all of the operating adjustments in the first quarter 2026. Could you give more color on what deliveries are outstanding still when it comes to this restructuring approach and what the sustainable margin levels could be looking forward? And the second question has to do with gross margin. There is a tailwind for the company with a weaker American dollar, but there are concerns from some companies concerning everything that is happening with memory out there. The price is rising. Could you talk a little bit about how you expect these two factors to impact the gross margin in the course of 2026? Thank you. Thank you, Clara. There are two interesting effects when we look at your question. The dollar is going down, but copper, gold, memory, everything is going up. So there is um, one thing canceling the other out. As for costs, there are memory costs that have basically doubled. They've increased twofold, and they're very important in some systems. So there is a cost increase that will be passed on to the market, and there are other technologies that will cover the use of this kind of memory, and that's also part of our portfolio already. So our work here, from an operations perspective, is really to have the availability of these memories for manufacture, because we see the impact as a minor one in our business. Now, the deliverables in 2026 mainly, well, we worked on reducing expenses, finding more synergy in the on the sales end um, um, with the IT team, with everyone, simplifying our portfolio. We've been reaping the results of these businesses. We have had more plant efficiency. We have had better output, better factory output. So these are two important deliverables that we have to have by the end of 2026. Of course, we need to balance our inventories so that it can be ever healthier and financed by our partners. Clara, you mentioned the dollar as a tailwind when you asked your question, and this is, I think, a perspective many analysts have. But we ought to be cautious because FX is part of the cost. If it's part of the cost, it impacts the price. The market understands that electronic devices will be impacted by FX. So whatever effect we get, it's going to be very short term. So we have to be careful when we project the um, the operations performance based on FX. I think it's a unwise and an unwise approach. If there is a positive impact in the one quarter, in the following quarter, it will be back to its previous stability. And if it had a negative impact on the one quarter, it will also have been stabilized by the following. We're still adjusting our inventory levels. We want the inventory to be more financed. So if we want to compare it to the third quarter 2024, we were loading up our inventories and the impact on FX was much bigger than it is now. It's quite clear. Thank you very much. If I can just follow up very briefly around the deliverables in 2026, the adjustments in the product mix, especially considering GPON, have they been completed? How do you mean that adjustments? Adjustments with the partnership with Fiber Home, the discontinuation of some products. I know that you discontinued some products that weren't particularly profitable. Would it make sense to discontinue more products? and pricing, how you're looking at that. This is in line with what I had said. We want a healthy relationship between Intelbras and the providers and the suppliers. As for the adjustments that were made, that was present at GPON and other businesses as well, but we analyze it in a broader perspective. Everything that will or will not impact our results and help pay the expenses of the company, and everything that does not contribute to the expenses, or there is um, a stumbling block for our ROIC, that is not going to continue in the company, whatever the business is. But GPON specifically, that is one business front that we are still working on. The volume decreased substantially, and it won't continue as it was in the past. What we are analyzing is what it's going to be like in the future, considering the changes we made recently. If it gets better, it will stay. If it doesn't, it will be dropped. That's very clear. Thank you. Thank you, Clara. Luis from XP. You may ask your question. Good morning. Thank you for taking my questions. I've got two as well. Capital allocation and cash generation is the first one. Cash generation was strong in 2025, and at the end of the release, you expect robust cash generation in 2026 as well. You also mentioned that the CapEx levels are going to be close into 2025 and 2026. You mentioned the CapEx possibilities in Manaus. Well, and there will be a lot of free cash generation. Do you have any expectation to increase the payouts? That's my first question. And the second question has to do with the EBITDA margins. The EBITDA margins it was 3.9 this Q. That was close to the highest historical levels. And during the call, you mentioned there is an inflection point for the margins now. Considering that security is increasing its share in the mix, and you see these OpEx efficiencies captured in 2025, and that should also apply to 2026, as well as an improvement in the margins in other segments. Could we consider that the recurring EBITDA margin is going to be structurally better than this 13, not lower, the lower end of the 13, but closer to 14? Well, we are designing a strong cash generation for 2026. We have this conservative expectation to have robust cash. We want to keep the dividend policies as is. We have a clear plan for 2026. And discussing the point again is not a problem, of course, but the distribution policy should remain the same. This message should be clear to the market. You shouldn't be speculating about higher payouts, hundreds of millions paid out in dividends. So the dividends should continue to follow the policy we have. As for the operational results, we expect to see improvements, but we can't forget that the fourth quarter, structurally speaking, always has better margins. you can look at that historically. You have more operating leverage. And I think it's wise to look at the models with a margin that grows in the course of the year. If we have a reference that is 13.9, it's going to be too high. The first quarter has lower revenue, lower operating leverage, and lower structural margins than in the fourth quarter. And we should see the margin improvement with more profitability and with better expenses control. Thank you very much, Bruno. Thank you, Enrique. Thank you, Luis. Daniel from BBI. Danielle Fedeli. We're close to the end of our call. There are some other questions here. And just before Daniel asks his questions, let me just clarify that we have taken notes of these questions. And myself, Luigi, we will answer them right after the call. Daniel, you may ask your question. You may unmute. Thank you, Bruno and Enrique, for your time. I've got two questions. The first has to do with the gross margin in security. When I read the release, it looked like the main driver for the reduction was some price issues, but when I listened to you during the call, it looked like it was more about the mix. To me, I had understood that the decrease in dollar prices had reduced the prices in the market, but it may not be like that. And ROIC is my second question. The company seems to be headed towards higher ROIC. Could you share with us where that's probably going to be stemming from? Is it going to be from better margins or reduction and capital investments, which is going to be the bigger lever? And any improvement in payables and receivables? Generally speaking, we need to improve on the numerator and denominator as well. In the first half, we're going to have a strong comparison to the first quarter last year, and then we're going to be seeing better ROIC levels or maybe a replacement. ROIC always looks back on the 4 past quarters. And when you remove the stronger quarter, then you change the return levels. You have a new, that's the numerator. And the denominator basically has to do with inventory and financing. If we look at receivables, we've been quite stable. Some fluctuation, depending on how you calculate it, but we don't really expect substantial improvements. Of course, there'll always be opportunities, but inventories and payables are the main focus. I like dividing payables by the inventory, and that will show how much inventory has been financed for the supplier. We had 80% of our inventory finance, and we have recently had 40%. We saw this change in the third quarter and confirmed it in the fourth quarter, and this should continue in 2026. So there is an improvement in results. There's an improvement in the capital structure, basically financing the inventories. And we can start discussing more efficient inventory. It can be more financed and be more efficient. But these are points that we'll need to look at later on as we see how 2026 performs. As for security margins, we haven't had any substantial change in the price tables with differences in dollar and FX. There hasn't been any major change stemming from the dollar uh, valuation or devaluation. Nothing substantial we did from a structuring perspective. What we see here is an impact from the mix. The mix was being sold in one way, and now it's being sold in a different structure in the portfolio. And that's natural for the business. It may even depend on seasonality as well. Alarms normally sell a lot at the end of the year because people are going to go on holidays, and then alarms sell more. You have better margins there. So it really depends on the mix. Just another point here. I think the market has heard this in previous uh, um, conversations. We have promotions, we have uh, sales, but the market, pardon me, the margin has been performing as expected. The fluctuations we see are no structural fluctuations. All right, congratulations. Thank you. Before we wrap up, I'd just like to say that we understand there are several questions that didn't get to be answered, but we have come to the end of the call. We'd like to thank you all for joining, and those who haven't had the chance to ask their questions live, the IR team and Enrique will review them and answer them individually. Thank you very much. And this is the end of our fourth quarter 2025 earnings call. Thank you very much for joining.